Welcome back to another episode of Profitless on Purpose, the nonprofit accounting podcast, and not just from one accountant's perspective. I'm one of your hosts, AJ Wheeler, but with me this week, as always, is Tony Cajigas.
Hello.
And Mark Palardy.
Hey there.
Got a great episode for us this week. For you guys this week, we have a couple articles. Our first article is Donor Relations Are About Money. You don't want to forget it, but we'll talk more about that and what the author thinks is the link to Aristotle's different kinds of friendships there. Then we have an article on what a finance committee can do for your board of directors. Does the author really know what a finance committee does? We'll talk about it and what she thinks a finance committee does and how it can help your organization. Then we have what heroic accounting is. Bet you never thought accountants were heroic, but I think this article from the Stanford Innovation really dives into a really good deep dive of what heroic accounting is, and we'll talk more about it in this episode. And then our question and discussion topic of this week is, what is UBI? How can you identify it? What are your strategies around it? We'll talk more all about it this week. But with our first article is Tony. Take it away.
Thanks, AJ. Hello, everybody. So the article that I have for you is called "Donor Relationships Are About Money, and We Shouldn't Hide That Fact." It was interesting. It was almost along philosophy lines because they get into your relationships with your donors. They give out like 3 friendship kind of things, and they talk about one relationship should be like a friendship of unity, which is based that each party benefits from the relationship. Another friendship was friendship of pleasure, which was grounded in mutual interests. And the third one was a friendship of the good, which was based on mutual appreciation for and the pursuit of virtue. So they talk about how your relationship with each of your donor is unique in itself. And most relationships are along the friendship of utility and the friendship of pleasure. They talk about also getting it to the virtue realm. And it just says that after all, if you and the donor both believe your organization's mission has a virtuous purpose, then you have a strong foundation for this type of friendship. So that's what their goal was, or they say what your goal should be within your donors. So what do you gentlemen think?
I guess I appreciate the author's stab at merging philosophy of Aristotle and giving. I guess for me, the article kind of, again, I probably sound like a broken record, but the article kind of reinforces that, giving in any sense from a nonprofit is relationship based. And I think having a clear idea of how to maintain that relationship and what that relationship consists of would be, kind of the development arm of a nonprofit needs to really heed that. I would say, me personally, I mean, if I'm looking at the way that the author kind of laid out the 3 friendships, I would say in a nonprofit sense and a giving sense, I think you probably, it's not a binary, 1, 2, or 3 here, what type of relationship it is. I would say, given his kind of, and we have a philosophy guru in the group here, so I'll let him speak more to this, but I kind of think that donors kind of fall into a little bit of each one of those camps. I think the friendship is not just this binary choice between the 3. So, but that was just my take on the article.
Yeah, I also appreciate the attempt to combine Aristotle's Nicomachean ethics with forms of giving. I think the real thing that the author is trying to get at here is that there is a common phrase in fundraising circles where people will say, it's about the relationship, it's not about the money. And this author is coming at this, I think, at a fairly honest standpoint by saying, sure, relationship is easy, is important, but it is not the primary function of what's going on here. So he delves into these 3 different types of relationship of utility, of friendship, and of virtue. And if we just approach fundraising and donors by saying everybody's here just for the good and just for virtue, you're kind of missing the point, right? Because donors expect, by the very nature of you coming to them and you approaching them, that there's some utility in this. You're doing an ask, you want money. So if you just treat it as all loving and a relationship and virtuous, then, if that donor ran out of money, if they went bankrupt, are you going to keep that relationship going? Are you going to remain friends? You might, but probably not on your work time, because you're there for the nonprofit to make the ask. I mean, we don't need to get deep into the fact of whether or not you agree with Aristotle to begin with, right? Because Aristotle's highest level of relationship is the relationship of virtue, but Aristotle's highest form of any human being and what they could best be doing on the earth is, surprise, surprise, spouting philosophy, right? So there's a lot of confirmation that bias that goes on with Aristotle to begin with. But I like the kind of the dichotomy and the ways to thinking about. I think we had an article in recent weeks, if you listen to past podcasts, about making the ask, right? And don't be afraid to make the ask. Like, donors know you're there for money. So, realize that utility piece of the puzzle is important, and you don't need to eschew it, as he would say, for something virtuous. We don't go to a donor and pretend that you're not there for money. It's a part of the deal. So I guess, that pretty much covers it.
But I think it doesn't just what Mark's saying, and he put it much more eloquently than I did, is that I think this doesn't just hold true for just a donor fundraiser or a donor and nonprofit kind of situation. I would say review the same kind of thinking when it comes to like a giving board. Oftentimes, I've seen boards and I've been on boards where it's expected you give, but nobody ever talks about it, right? Because they don't want to upset the apple cart or whatever. But I think it's absolutely a requirement that if you have a giving board and that you're requiring board members to contribute to the organization, that you make that apparent and, not necessarily name and shame, but remind people and make the ask, I think. So I think it's really kind of, like the mission of a nonprofit is to bring in donations and ask for money. And I think, that doesn't just fall to the development department. I think it falls through to the board too, if you have that type of board. So I would just say kind of, think about this article, or think about like making the ask from all of the organization and not just see it as a siloed thing that the development department does. So, and you can be friends with somebody and ask them for money too. So, but Mark, you got our next article for us?
You bet. This article is called What a Finance Committee Can Do for Your Board of Directors. And this is by Ruth Seedorf from a site called Blue Avocado. Authors note, if your avocados are blue, either get your eyesight checked or, maybe don't eat it. Anyway, the article itself is talking about implementing a finance committee and when the right time is, right? Usually when you start off in a nonprofit, it's going to be small. You have a treasurer, you have your other executive committee on your board, but you might not have a finance committee yet. And so this author is kind of presenting a case scenario for her nonprofit as to when and how to kind of make that decision to have a finance committee, and then what that finance committee can do. Whether or not we entirely agree with what her conclusions are, we'll talk about that, but I'll just present the case as it's laid out. So when leadership decides that they've grown to a place where it's helpful to have a finance committee, the first thing they're going to do is they're going to kind of have this initiation process where they want to figure out who they want on a finance committee, right? They want probably a breadth of knowledge of different kinds of minds that understand finances, but aren't all approaching it. Like, you don't want 5 CPAs, because there's going to be some groupthink that happens here. So you want to have expertise in the field, but also varying expertise. Like, you might have a banker or an insurance person or, whatever, retirement counselor, or however that looks, but people who understand the finance process besides just accountants. You want to represent with that selection, you want to form your finance committee based on job descriptions. Like, what are you looking for? Who needs to fit that niche, right? So if you are forming your finance committee and you have 3 people selected, what are some of the skills that are still necessary that you want to fill in the gaps so that you have this well-rounded, broad finance committee to give insight? You want to start creating regular meetings, whether that's monthly, whether that's quarterly or semi-annually. You probably want to meet with the finance committee as frequently as the board meets, because in a board meeting, they're often going to want a report from the finance committee, because that often can drive or be a big driver on what the programs, how successful programs are being, and whether or not you can expand and do other things. And the finance committee, even more so than just a treasurer alone, can help shed light on some of those things. So now we come to the interesting part. What does your finance committee do, right? So often they're going to help with budgeting processes. Often they're going to help in an oversight realm, looking at, what the budget looks like, what we've been spending on, variances, and helping determine, where the finances are at, and helping to devise metrics for the organization. Some other things that the author suggests that the finance committee could do is identify some avenues for funding, and helping to enhance these outcomes by helping with fundraising. I say the author suggests that. I'll leave that on the table for now. But let's just keep in mind that a finance committee is the committee of oversight. So, this is a step that inevitably happens as a nonprofit grows. So I think figuring out when that step is important for every organization, and not trying to keep the burden solely on the treasurer is important. So, as you're starting to take that step, I would suggest reading the article, which we'll link below, but reading some other sources as well. So what do you gentlemen think?
I'm giving the author the benefit of the doubt here. I'm assuming that this is a very small nonprofit, and what she has kind of laid out here is what the finance committee does is kind of a blend of what a finance committee and a fundraising committee does. So, I wish she would have kind of titled the article different, because a lot of what she's saying here is really what a fundraising kind of arm, a fundraising committee or fundraising arm of an organization would do, But I think it highlights that at a small nonprofit, or in the life cycle of a nonprofit in the beginning, you're often kind of clobbering together. If you have enough people to put on a separate committee other than the board committee at the beginning of a nonprofit, you're headed in the right direction. I hopefully, that you have enough engagement that people want to engage outside of just the monthly or bi-monthly meeting that goes on, or however often the board meets. But I would agree with Mark that a lot of what's listed in here as the finance committee at work is realistically a lot of what a fundraising committee would do, and steering a fundraising committee. I'd also say that some of this stuff crosses into operational kind of operate a fundraising or a finance operational kind of duties that would normally in a larger nonprofit be handled by the finance staff or the accounting staff of a nonprofit. She mentions organize and receive a PPP loan, and then getting it forgiven. Under normal circumstances in a robust or a mature nonprofit, that would be all done behind the scenes outside of a board or a committee. They might talk about it in a finance committee. They might look at the outcomes of these things, but setting it up and delivering on this kind of stuff is really either a specific committee related to fundraising or funding, or it would be a situation where you would have an internal accounting team kind of perform these functions. So I would say kudos to the article's author and to her nonprofit for having this kind of engagement with the board, but I don't necessarily know I would call this a true finance committee.
Yeah, I have two trains of thought here. One is I agree with what AJ said in the fact that I feel that normally, I may be wrong, normally very large nonprofits would be able to put together a finance committee. And if they were to put a finance committee together, they would also be big enough to have a department or people who are in charge of fundraisers and different types of departments. Now, on the flip side of that, smaller nonprofits that maybe just throw a board together and want to get people just to start expanding and growing their nonprofit. You have to be careful because a lot of people might not have experience in finance. Thus, board members may lead you astray. So as you grow, it's important to get the right people on your board. Like I believe AJ said earlier, you want to get an insurance person in there, maybe get a previous accountant or an accountant in there to help make proper decisions. So it was quite an interesting article.
Yeah, I think for myself, I presented the article, but I would agree with both AJ and Tony that it's, when I'm treasurer on a board, even before we get to finance committee stage, I'm overseeing the money. I'm not raising the money. I think there can be a real conflict of interest when you have somebody who's both raising and counting the money. And I like to keep that separation because, you want to be able to critically evaluate the fundraising arm. And if you have somebody in the finance committee who's actually raising the money and then having to evaluate their own work, you're often not going to get the truest picture of what's going on. So I don't know that much more needs to be said here. I think it was a good effort on her part. And, with small nonprofits, sometimes people take on multiple roles and have multiple hats. But, if let's say you had 5 people on a finance committee, I would rather see you have 3 people on a finance committee and then create a separate committee for fundraising and split those into 2, just so that you have that wall between where evaluation can happen on both sides of the fence. So anyway, with that, I think AJ has our next article.
Yeah, so my article comes from the Stanford Social Innovation Review, which is a mouthful, SSIR for short. But the title of it is 2 words that don't usually go together: heroic and accounting. And I was kind of interested in what this was. The tagline for the article is "New proposals for monetizing corporate planetary impacts are alluring, impossible, and perilous." So what are they talking about in this monetizing corporate planetary impacts? What it is essentially, and I'll give you the back of the napkin or back of the card Jeopardy answer to this, is that it's supposed to be a financial measure of how sustainable and equitable a company is. And they're talking about, kind of the impact accounting to tabulate every way that individual companies influences planetary welfare, including economic profit, employment, social equity, biodiversity, and climate, and translates all this into some kind of measure of impact represented in dollars and cents. So they talk about the allure of this, and they promise it will reshape capitalism itself. And despite many of its flaws, our current system of capitalism is about enormous improvements in life expectancy and living standards, yada, yada. But then they talk about like kind of the downside of capitalism, where everybody's focused on the quick dollar, kind of the short-term profitability of a company, and always more. And what this kind of the allure, the social impact, kind of putting a dollars and cents to how much pollutants a certain industry gives, or how much social impact they have or don't have, or how much diversity they have it. So they talk about kind of the benefit to the consumer if they were able to look at a defined kind of score for how they're defining this, like public good, I guess, score. They're saying that people could look at that and make informed capitalistic decisions based on this score. So then they talk about kind of the external impact and what the perils are of this, where it's very hard to drill down and understand the dollars and cents behind carbon emissions. Now, we've seen this done with, kind of carbon tax credits and such in the past, but they talk about, you're not just talking just about carbon emissions, you're talking about impact and sustainability of a company, you're talking about equity and diversity in a company, you're talking about all these different things that they're trying to boil down to a dollars and cents kind of thing. And the article is quite lengthy. Anybody that's listening, I would hope you could go check this out, because it really dives into the nuts and bolts of all this, and it's a very good read. But they talk about how this isn't going to be obtainable because of the trying to quantify something that's very much kind of like woo-woo, for lack of a better word, and trying to assign a dollars and cents calculation to things like equity and inclusion and such is very difficult to do. So what they ask, what they do, what can be done instead, and they talk about calculating the financial impact of the environmental externalities, and essentially what they're proposing in this new kind of heroic accounting is a different measure than just the financial balance sheet income statement that's being presented now. They want kind of an alternative, kind of almost like a management view of results of operations and a forward-looking kind of number to go off of. So essentially they say that this isn't going to work and that there needs to be an alternative to this, and the alternative that that they offer is some kind of other measurement that would be derived, that would prioritize remediation, and that how imprecise all of this measurement is. So I'd like to get your guys' kind of take on the article and see if maybe the author is, too stuck in the past to be able to see the future of this kind of heroic, off accounting kind of measure that they're talking about, or if in fact this is, a hill too high to climb, if this is a hurdle too high to jump to be able to reach a unanimous kind of underlying measure of these things that they're talking about.
Yeah. I don't see how this can fly. It would just, to me, it would seem to be so complicated. And how would one translate social, human, environmental impacts into dollars and cents? I believe the article gave three estimates on what some carbon something or other would cost, and they varied quite a bit. It's just there's so many different minute things that they're looking to quantify. It just seems that it would be very time consuming, and how in the world would you measure the cost of something like that? Then they talk about perhaps they would have to bring in some more economists and perhaps analysts to determine these quantifying measures and costs. And they mentioned that it would probably, they would have to hire thousands, if not tens of thousands of more analysts to figure out the costs of all these measurements. It's just, I don't know. I just don't see how it would work.
So I'm going to take a bit more of an optimistic view here. I love this article. I think this is one of my favorite articles that we've actually done on the podcast. And again, I encourage you to read it. But the idea of impact accounting, right? The idea that we as a society don't have to stop at capitalism's edge and say, this is the end result, right? We're done here. It's all about the almighty dollar and how much we can earn. And profits in the stock market are the only metric by which we can measure a company. The fact that there are accountants out there who are looking to these things Is it attainable today? Absolutely not. I totally agree with Tony. And that this is a fool's errand to try to get this done today. But movement in this direction is great, right? Because it actually starts companies thinking about what some of the impacts are that they're having on other aspects of society, and that it isn't all about money, right? And this article kind of goes deep into depth as to, well, who is weighing what is good and bad. And like we mentioned in the previous article, I'm kind of the philosophy guy. So those kinds of questions really appeal to me. Like, is taking a flight to go visit your family or to go on vacation, is that a good? Maybe, yes, right? Or is that a bad because you're polluting the environment? And, so there are not necessarily easy answers as to each activity and how much you're putting into pollutants into the air, whether it's good or bad. And it's on this kind of scale that is constantly changing and constantly needs to be evolving. So as I'm reading this, I mean, the author clearly also agrees with the conclusion that this isn't the way to go. And his solution in the very latter part of the article, spoiler, is that he thinks more government regulation is the way to attack some of these problems, which, sure, is a good stopgap measure. But if we're going to stick on the accounting side, which I'm wont to do because I'm an accountant, right? I start thinking about what the future looks like in 10 or 20 years as computing, as we get into quantum computing, as we get into more and more complex systems. Because if we looked back 30 years ago at computers, they couldn't do 1/100th of what computers today can do. So if we look forward into quantum computing and other aspects of technology that can start to measure some of these quantifiable things and assign them values, I think that's where the tricky part comes in, right? What do we assign as good or bad? But if we start assigning dollar values to impacts, social impacts, environmental impacts, other impacts of company behaviors, we at least start getting closer to a metric, right? I think one of the quotes that I highlighted in here, I'm not going to get it right, but it's better to try something than to try nothing at all. And I love the fact that accountants out there, I mean, I'm very passionate about this, are looking at this and saying, is there a way that we can quantify impact of a corporation on a society? And if so, let's add that as a measurable metric, because if we're only looking at profit, which we've looked for the past 100 years, it's only about the profitability of a company, then eventually all the negative consequences of that catch up to us as they are now. So I'm very hopeful with this, and I'm excited to see what impact accounting is going to look like in the coming decades.
And I would say that this has already started a little bit. If you haven't heard about B corporations, it's a designation that kind of you have to jump through some hoops where you present yourself as a sustainable organization and you get a B Corp certification that kind of shows that. We could probably do a podcast in of that as an article or a discussion point. But you also see like outside of a financial report or a financial audited financial statements, you also see like a yearly kind of annual report. And this holds true in nonprofit accounting and outside of it, as to kind of like they kind of try to quantify some of this stuff. Usually it's like a results of operations of how many people were served in the nonprofit, or how many mouths were fed, or how much public good they did, to try and quantify that, coupled with some financial outcomes as well. So I think we're moving. And then also too, I almost forgot, we have the carbon tax credits that exist. That, in fact, when I was in public accounting, we had a client that they traded in carbon taxes. And I just remember how difficult it was as an auditor to quantify and to value those carbon tax credits. I mean, you're literally talking about valuing air or pollutants in air and how those were traded back and forth between companies for tax credits. So I think this is, the author's right, I think, in saying that this is a pretty big surmountable kind of problem that persists. But I would agree with Mark that I'm glad to see that people are actually talking about it now. If we would have brought this up in the 80s, you would have been laughed off the stage, I think, because this just wasn't in the forefront of thinking, maybe a small minority of business owners and the general public. But I think nowadays, I think you really see this as being, something that might be obtainable at some point. It's probably one of those insurmountable hurdles right now because of the computation required to come up with something like this. But I would say that it's not like that people aren't trying. And there are measures out there, I think, that if you're concerned about a company or a nonprofit, that you can look to some kind of measures that they're providing. Now, whether it's greenwashed or whatever you want to call it, and inflated numbers to try and make themselves look better, we can argue all day about that. But the fact that the public is requesting this and it's providing some kind of movement inside nonprofits and outside of nonprofits in the for-profit realm, I think it's kind of like a good measure that we're moving in the right direction, I think. And this is all going to take time. And so I think it's heartening to see that, but to the point of the article, it's not something that we're going to solve this year or next year,
No, but I am waiting for that day when Bette Midler gets on her stage and sings to all the accountants, "Did you ever know that you're my hero?" All right, Tony, I think you got today's topic for us.
Yes, I do. So this topic is related to UBI, which is unrelated business income, and which is income not related to your nonprofit purpose or function. So the conundrum here is there's a nonprofit. They give gift cards to families in the NICU at hospitals to cover everyday expenses such as gas and food. Now, what this nonprofit does is they sell T-shirts on their website, and they use the money from those sales to purchase the gift cards. So they believe that selling the T-shirts on their website would be considered UBI, but then they want to know, would revenue from the T-shirts and other branded merchandise be UBI since they use the funds to purchase the gift cards? So what do you gentlemen think?
Boy, unrelated business income. So I would say for this specific nonprofit, if you're listening, I would first of all consult with your CPA that does your 990, or engage a local CPA to really look at the details of this, because as with anything tax related or even, really like in-depth accounting wise, the devil's in the details when it comes to unrelated business income. So I think Tony kind of gave, a quick definition of UBI, or unrelated business income. But I think it's important to reiterate that unrelated business income is income made doing something in your nonprofit that is not related to the nonprofit status or the reason why you're a nonprofit. So let's do an example. Let's say you're a youth organization that provides like after school activities at a location for kids. After school activities for kids. Well, like your time, you have this big building that you own, and the only time it's used is weekends and after school. So you rent out the facility on a Wednesday for a wedding reception. Well, now on the face of that, that's unrelated business income. This property rental that you've done is not related to helping kids after school or after school activities or youth. Now, let's take that. So that would be considered UBI in this very basic, kind of example. Now, let's take that same kind of nonprofit that has after youth activities, and they provide some kind of job training to the youth. If you rent out that space to like a wedding reception, but you staff it with job trainees from school activities or whatever, then you could make the argument that is related to your nonprofit mission or your nonprofit exempt status by providing job training to school youth programs. So I think it's really the devil's in the details. From the limited information that this question asked, I would have to say that probably the T-shirt sales sound like UBI, but again, the devil's in the details when it comes to this kind of thing. So again, ask your CPA.
Right. I think you'd have to ask the question: are these prenatal children making the T-shirts or not? But uh, when it comes to UBI, right? Most small nonprofits have never heard of it, never think about it. Right. One might even say they're UBI soft or Ubisoft. Anyway, so I think what we need to do is we need to look at each individual activity and have your finance committee, your board of directors look at the individual activity and decide, is this something that is going towards our mission? And there are some areas that might be gray areas, like in AJ's example. I used to work at a museum where there was a parking garage where that income from the parking garage was not related directly to the mission and vision of the museum itself. Therefore, it was considered unrelated business income. So is it worth it to you? And I want to also say, this does not mean that UBI should not be gone after, right? It doesn't mean that you should never, that your goal is to not have UBI. You just need to be cognizant that if you do have unrelated business income, that it's subject to tax, right? Because everybody thinks nonprofit, I don't have to pay taxes. Well, on your 990, there are some areas where they talk about unrelated business income. And if you bring some of that in, then it's subject to income tax. So have awareness of that. But if it still makes sense for you as an organization, don't be scared of it. Just go in with knowledge that it might be subject to tax. So I think that's all I have to say.
If it makes sense, dollars and cents, you mean? No. But I would say, I think the real discussion point here is identifying what UBI is and then having a discussion about that, because not only as a nonprofit, you're given some benefit here. Like, for instance, if you're selling advertising for a publication that you put out, that's unrelated business income, but you get all kinds of deductions for it, so I would work with your tax preparer, whoever does your 990, to be able to realize what you need to be tracking if you have UBI too. If you have UBI, you need to have a robust idea of what your cost of goods sold is. You need to really realize what your deductions available to you are from a nonprofit standpoint, and really have them do the legwork on what information you need to provide them to get an accurate idea of, and then to be able to plan how much you're going to owe in taxes. So I think it's a really good discussion point, but I think, knowledge is power here. A lot of people aren't even aware in the nonprofit sector, aren't even aware that UBI is a thing. So kudos to the person that sent the article in, or sent the question in, excuse me.
All right, and with that, gentlemen, I think we've reached the end of another exciting Profitless on Purpose podcast. Some good discussion topics here today. We'd love to include you in on the discussion. So please send us a tweet at ProfitlessPod, or make a comment down below the YouTube video. We always welcome your comments and questions. You might actually hear us answer something on a future podcast. But for this week, on behalf of Tony, on behalf of AJ and myself, thanks so much for joining us, and we'll see you again next time.
Thanks, everybody.
Thanks, guys.